Right, good morning. It's Tuesday, June 17th. I'm Zach Howard. Here's my morning market update for you guys, what I'm looking at today. So we're going to fade the noise. We're going to look for signal in markets, okay? Fade headline media and all opportunities. Let's look for signal. And one of the favorite signals for me, a part of my process, shorter term and term, longer term, is volatility. Volatility regimes drive market flows, good or bad, positive or negatives. We're looking at a chart of the implied volatility on individual names in the Nasdaq. And we've seen that big spike up to 51.8 on peak fair day, Liberation Day back in April. The market sold off heavy. We've had a steady decline in that volatility on those individual names ever since, and it continues to put a bid into market. Here's another chart of that on the broader scale. The VXN, the volatility of the Nasdaq 100, the top 100 companies in the Nasdaq, dominated by those mega cap tech names, particularly Mag 7. We continue to follow there too. But looking at this historical band now going back since December is in this like 19 to 24 range. And you get down around 21 here, it really correlates to a risk on bid into markets. As you see on this nice chart here, 15 to 20 is really, we can buy anything. It goes up. You get it down to 15, fart coin and stupid shit like that, even it starts rocketing higher. You get into the danger zone over here, 45.50. That's when markets sell off high. We just touched on where we're to now currently, 21. And what's bringing that volatility? Looking back now in hindsight, obviously that peak Liberation Day fear, 51, was a contrarian indicator. We should have been buying stocks hand over fist. But it's hard from an emotional standpoint as humans when we see the fear, reading the headlines. We're not just looking at the data. We're not looking at past patterns where these volatility regimes can't really sustain themselves. That's really when you should be stepping on the gas and buying. We get volatility pulling back here like it is now. That's probably where you want to buy some protection. So what's causing this compression? Well, there's a few different things. The key drivers really, the flows of markets. There's more flows funding in to the market, especially these higher beta trades in this macro regime where growth is going to expect it to continue to accelerate and inflation is expected to accelerate. That is really the backdrop. Stability after those spikes. You have the falls. Fed rate policy decision is kind of pretty clear out there for the markets right now. We do have a Fed policy decision tomorrow out of the central bank in the U.S. Potentially there that Jerome Powell pisses off Trump and says something stupid in the post presser. There's no rate cut tomorrow coming, but if he says something stupid, that could trigger a volatility short-term cluster, which opens up the opportunity for more buying. Because long-term, we're zooming out. We're trying to see the bigger picture long-term. So there's fewer major market moves that are sustaining themselves in the current market environment where 0 days to expiry options really drive protection on the shorter term. Market players not buying long dated puts. They're only putting on protection for the day, the event, Fed meeting, CPI day, unemployment day, these type of things. That's why it presents more opportunities on the buying side here. However, there is increased risk of spike for short-term market pullbacks. But what we got to do then, we got to turn off our emotional side of our brain and say, well, what's the longer-term picture? Let's zoom out, give us an opportunity to buy positions we already understand or are comfortable with when we get those pullbacks with volatility rising. Lower option prices, volatility risk premium is falling. So there's not a lot of appetite for buying puts in this environment. They are much cheaper than buying calls. The implied volatility thus continues to fall. Actions to look at, like I say, Fed day tomorrow. If he says something stupid, that's an opportunity to potentially load up. You want to have some cash going into that opportunity. Also, then on Friday, we have a big record, almost record-setting notional 4.2 trillion, 4.3 trillion almost in options expiring. That's going to be rolled as we go into the quarter end here, the end of June. So there is potential here for a pullback into July as these options roll off and the pin action around gamma positioning, that 5,950 strike on the S&P sets the door up for a short-term pullback potentially in July. But zoom out longer, bigger picture, number go up. That's the theme for all this stuff. Debasement by any means necessary, and the stock market has to chug along higher in the long term. Have a great day. I'll see you tomorrow.